Hi, and welcome to Invest Talks, the podcast by Cassiopeia Services. This is Stefania, and today we are going to talk about investing in precious metals. Um, What's happened with the pandemic has been crazy, had a very strong impact on the economy, and we are really in a recession where people are going to be really careful on the type of investment they are going in. So obviously, as the financial market has been very volatile, fiat currency has lost lots of value, inflation is rising, and also there is uncertainty about the future with lots of political tension as well on the go. Investors have gone into more safe haven assets like gold, and they also try to find way to differentiate the portfolio, investing in assets they are not so directly linked with the economy and the markets. And that's why obviously we have seen lots of people investing also in Bitcoin and considering some other investment that is not really equity or currencies. So let's focus on gold and silver today, because what I want to ask my guest is, we have reached the all-time high in gold, and also silver has been quite high as well. Is that hit, or investors still have the opportunity to join the rise and chase the market, or they should actually wait and see, because we are actually seeing a consolidation of the price of those two metals. Timing is always key in any investment, and you don't want to jump at the top when the party is kind of already going. You want to come in, at the bottom, or a stage where you can still maximize your profit. So let me welcome Ian Williams, who is the Chairman and CIO of Charteris Treasury Portfolio Managers. Hi Ian, how are you?
All right, thank you. How are yourself?
I'm fine. So how are you keeping?
Very well, thank you. Very well. We're having a very strange year. All our funds are doing exceptionally well. So we're having we're having the best year ever, actually, in the history of the company in terms of performance of all our funds, not just the gold fund.
Yes, because do you want to give a quick overview about your funds and where actually you invest and your criteria as well?
Okay, well, the main purpose of this podcast will be the gold fund, which we invest in. It's a UK, all our funds are UK OEX, open-ended investment companies, got daily dealings, daily valuations, so there's no lock-ins, no bid offer spread on buying the fund. The gold fund invests in, the biggest holdings we have geographically are in Canada. So something like 85% of the fund is in Canadian domiciled mining companies. The other 15% are in the UK domiciled, USA and Australia. We don't buy any South African domiciled mining companies. Within that, the fund is split 50-50 between gold miners and silver miners. We also run an equity fund, which is in the equity income sector in the UK. That's currently top of the league this year, or second top. It's sort of unchanged, which is pretty good considering the FTSE's down about 15%, and a lot of the funds in there, big name funds, are down over 30% this year. So that's done really well at the top of the league. We also run a global income fund. That's at the top of the league as well. And we run a bond fund, which is sort of mid-table, not really doing very much. So that's our four funds. Three are at the top of the league. So, we're having, as I say, the best year we've ever had.
Yes, it looks like, which is, is good to hear, because then that some people are actually making money.
All our clients, all our private clients are all, they've all made money this year. They're all up on the year, and some are up quite decent amounts. I mean, because it's not just the gold mining share. We've got a big exposure to gold and silver mines, which has been one of the reasons that they've done so well. But also the base metal miners, the Rio Tinto Zincs and BHP Billitons and Antofagasta, stocks like that, they've done very well as well. So people tend to forget about that. But copper long term with all this money printing, copper and lead and zinc and all these base metals, they're just as much as an inflation-proof hedge as gold and precious metals are. So ultimately, they're going to enjoy a similar sort of run to what some of these gold miners have been on.
Okay, so let's talk a little bit about gold, because I mean, gold has reached its all-time high, and then we have seen recently that Warren Buffett actually is not a fan of gold. He bought his first gold mine, taking a big stake
That's
in
right.
the second biggest gold mine about gold. So that was kind of like a news, let's say. And
Yeah.
how investors should take that? Because my question would be, is still time to chase the gold market, or we are actually going through a consolidation and we have kind of reached the all-time high where investors can maybe look somewhere else, for example, silver, for example?
Okay. Well, we think gold is going to go higher from here. We don't think $2,000 is the top, but we think it short term, by the end of the year, say, we think it might go up to 2,300, something like that, which is okay, but it's not spectacular. Silver, on the other hand, silver is up 50% in the last 3 weeks. That is spectacular. And silver is still only half its all-time high. So whereas gold is in $2,000 is at its all-time high, silver's all-time high was $50 an ounce. It's currently $27 an ounce. So we think there's a lot more to go for in silver than there is in gold at the moment.
Okay, and obviously silver is very different from gold as well. I mean, you are an expert. Would you like maybe to explain the fundamental that drives the gold prices, and when it's better to buy gold, and on the other hand, what are the fundamental of silver and when it's better to buy silver?
Okay, well, the huge difference between gold and silver is central banks don't buy silver. So Russia has been a huge buyer of gold over the last year or two. It's been diversifying out of its US Treasury bonds. China has been doing the same. Chinese central bank's been a big buyer of gold, but they don't buy silver. So that's one very big difference between gold and silver, is central banks don't buy silver. So the audience, the buyers of silver are different. Also, as you know, silver is it's a semi-industrial product. Although having said that, the biggest demand over the last 10 years for gold has been jewelry, and the jewelry industry is an industry as well. So you can class, or I would class, jewelry demand as industrial demand, but people think, whereas silver demand is slightly different. It's used in making solar panels, it's used in water purification, it's used in a whole host of mobile phones and mobile telephone. It's very much a metal for the new economy and the new sources of power and everything. So there's potentially huge demand, industrial demand for silver, but this year it hasn't really been an industrial demand story that's pushed gold and silver up. It's been investment demand. Investment demand at any stage can completely dwarf the industrial demand. And also the other difference is that, especially with gold, it tends to have a very seasonal pattern to its traditional demand. So gold tends to do much better in the second half of the year than the first half of the year. And the reason for that is the main driver is jewelry demand. And the main driver within jewelry demand globally is from India, with the Indian wedding season, which takes place after the monsoons. That's been a huge demand for gold in the past. Then you've got Christmas in the West, which is, again, leads to huge demand in gold jewelry. And then straight after that, you've got Chinese New Year. And the Indians and Chinese virtually buy up the entire world supply of gold between them. So you tend to find that gold tends to do much better in the second half of the year than the first half. Now, this year has been slightly different because whereas gold normally struggles in the first half of the year, it's actually done very well. And the reason it's done very well is because the investment demand has kicked in with all this, what's going on in the markets and everything. So the investment demand has dwarfed the lack of, or made up for the lack of jewelry demand. So what's going to be interesting now as we go into the second half of the year is the very high price in, say, rupees, the rupee price of gold, is that going to put a few Indian buyers off buying gold? Or are they just going to buy it anyway? So we don't know that. That's an unknown. I suspect they'll continue to buy it, but might maybe not buy quite as much as they have done in the past. But there's also stories that because gold is so high now in rupees, a lot of Indians are buying silver instead. So again, you just we need to wait and see on that one, how that one turns out. We won't know really until you start getting into September and October, and when you can start to see how much Indian demand's coming through. But normally, we're now going into the strongest part of the year for both gold and silver on its historical seasonal pattern.
Okay. Is there any other element or any other events that the investor should bear in mind in order to understand how the price of gold and silver can move up and down? I mean, from an economic perspective.
Well, you see, this year the investment demand is much bigger, and the investment demand isn't really subject to these seasonal patterns like the physical demand is. So it may be that if other things kick off in the markets, you may see some investment selling. You can't rule that out. We've seen lots of investor buying. But talking to the investors that buy into our fund, the main reason they've been buying so much gold and silver is the amount of money printing that all these central banks are up to. That's been the main driver of investment demand. As it was in 2007, 2008, when they first started quantitative easing. When Ben Bernanke first started it, you saw an absolute rush into gold and silver. I mean, silver went up from $10 to $50 on the back of QE 1 and 2. Now, this time round, this QE is far, far bigger than what they did before. And whereas the QE 1, 2, and 3 was like the Fed's balance sheet went from $1 trillion to $4 trillion over 6 years, this time it's going to go from $4 trillion to $10 trillion in 9 months. So not only is it far bigger, but it's condensed into a much shorter timescale. And what the previous QE was tending to, the money never really left the banking system. A lot of the reason for QE was to bail out the banking system, which had gone bust at the time. This time round, the US Treasury giving $600 to each family. Where's that $600 coming from? Well, they're just printing it. They're printing money and giving it away, wiring it into people's bank accounts. This is, the original helicopter money. So this time it's getting into the economy as well. So it's far bigger than before. It's crammed into a much shorter timescale than before. And it's going directly into the economy, whereas before it pretty much stayed inside the banking system. So it's far more, because it didn't necessarily cause a lot of inflation last time, doesn't mean that this particular type of QE on the scale it's on, and it's worldwide as well, it's not just in America. So this is inflationary. There's absolutely no way that this ultimately won't cause inflation. And that's why you've had such big investment demand. And as long as the money printing continues and there's no sign at all that anyone's going to turn off the money tap, the demand for gold and silver will continue as well.
I think also the fact that we don't know if there will be a second wave of coronavirus, I think that is also posing a bigger question, as well as, we know that we are in a recession, but we don't know how big and how deep is going to be this recession.
But the bigger the recession, the more money they're going to print.
Exactly. But listen, talking about this point, because, you probably know as well, many investors, as they are looking at gold, they are also exploring other assets such as Bitcoin, which has very similarity to gold because they are both hard money. Instead, you see fiat currency that is more like a soft money that, some people say is kind of manipulated, and it is actually manipulated by the central banks. What is do you have a view on Bitcoin and, any kind of comparison with gold at all?
Not really. I mean, from our point of view, why buy fake gold when you can buy real gold? And to me, I don't really see the logic of buying Bitcoin instead of gold. I can see the logic maybe of buying Bitcoin instead of Treasury bonds. But then, I can see the logic of buying anything instead of Treasury bonds, because that's effectively throwing your money. That's the most dangerous asset you can buy, especially long dated ones. Same over here in the gilt market. You couldn't conceive of a worse investment than buying a 50-year gilt on 0.5% gross redemption yield fixed for 50 years. I mean, what sort of idiot would want to lend their money to the UK government at 0.5% for 50 years? It's beyond belief that anyone thinks when inflation is going to be 2, 3, 4, 5%. It just is insane. And yet, if you look at average private client portfolios, a lot of private client managers, they got 40, 50, 60%, or they got 1% or 2% in gold. And they think and then they can't understand why they're not making any money and losing money in this environment.
Exactly. So talking about investment portfolio and what a private investor, should do to make sure that he has got a good diversified, range of assets. What would be your advice in terms of allocation of investment?
Right. Have the lowest rating, preferably 0 in any form of bond or fixed income investment. Because if our view on inflation is correct, your value of your money is just going to be decimated. It'll be decimated through inflation, eroding the real value of the money. And in turn, once this inflation starts to kick in, and it will kick in 2-3 years down the road, at some stage, the central banks will have no option but to raise interest rates. So on a bond, you lose money on both ways. You lose money through inflation eroding the real value of the bond. And then ultimately, as the central banks have to deal with that inflation, they put interest rates up, and then the nominal value of the bond, the price of the bond, will also start to go down as the yield goes up. So you lose both ways. And in the meantime, all you're getting is 0.5% return, which in no way compensates you for the risk you're going to take. So buying long bonds is almost a guaranteed way to lose money in this environment. So anything is better than holding bonds. And that can be, and at the other end of the extreme, you want inflation-proof assets will prove to be the best. Everyone goes on about tech this year. Gold mining stocks have done better than tech. Tech is not the best performing sector this year. The gold mining sector is. It's beaten tech. And the reason it's beaten tech is because investors conceal this money printing, and then they want hard assets. And at the end of the day, it's not just gold and silver miners. It'll be copper miners and metal miners. It'll be assets that go up in line with inflation, including houses. People's house will go up in line with inflation, as they've always done before. So you've got to try and work out which sectors of the equity market are immune from another round of coronavirus. So you don't want airlines, you don't want probably too much retail. There's not much point buying banks at the moment. There's lots of sectors to avoid. But there's other sectors like insurance, which is fine. Tobacco, pharmaceuticals is obviously okay. Utilities, with people staying at home using lots of it. So there's lots of sectors within the equity market that are pretty much corona-proof. But there's other sectors like airlines, which, if you don't get a quick end to this, a lot of these airlines just aren't going to survive. So, and same for hotels and restaurants. Well, you don't have to buy shares in those sectors. So then, but bonds is the worst you could buy. I mean, fixed income in this environment could turn out to be an absolute disaster. And investors worldwide have far too bigger exposure to bonds and not enough exposure to hard assets, inflation-proof stocks.
And I also think even the concept of cash is king, I think at the moment is quite questionable as well.
Well, if you get 3% inflation or 5% inflation, you're getting 0.25% at the bank, or even worse in Europe, you're having to pay to deposit your money in the bank. But so you get 0 or next to 0 in the bank, and inflation comes into 5%. Your £1,000 or £1,000,000 in the bank is worth 5% less in real terms in a year's time. So it's cash is not king in this environment. Cash is on a par with bonds. I mean, at least cash doesn't go down in nominal, but it will still be eroded if you get inflation and you don't get an interest rate to compensate you for the loss of purchasing power through inflation.
Yeah, that's actually true. The last things that I would like maybe to discuss a little bit more is you mentioned about copper and
Mm.
metals, and we haven't talked much about it. Do you want maybe to expand on what is the opportunity here?
Well, if you're going into a world of electric cars, for example, an electric car uses up 4 times as much copper as a petrol car or gasoline car, whichever country you're in, whether it's gasoline or petrol. We call it petrol over here. In America, they call it gasoline. But copper uses up, you need 4 times as much copper to make a car, electric car, as you do a normal car. So if the world's moving to just electric cars, where is all the copper going to come from to make these cars? Now, China's been quite smart because China has quite a lot of been gearing up for electric cars for the last 20 years and has been quietly going around the world, buying up mining companies and taking stakes in mining companies and buying copper deposits. Chances are, if you own a mine anywhere in the world that's got a decent supply of copper, you've had a knock on the door in the last 5 years from someone from China wanting to buy your mine from you. So when they go full on to making all these electric cars, the Chinese have probably done more than anybody else to source the supply. So it's all very well arguing over which battery you're going to use. Are you going to use a nickel cadmium or lithium battery? It doesn't matter. Whichever battery you use, the car still needs 4 times as much copper. And if the likes of BMW and Mercedes can't source it, they haven't tied up the long-term supply of copper like the Chinese have done. So the Chinese car makers have a tremendous built-in strategic advantage now, and they've got lower costs of making it. So they're just going to swamp the global market with Chinese-made electric cars, and they'll dominate the market. And they've got all their ducks in a row. So copper, the demand for copper is potentially going to way outseed the supply just purely from electric cars, as is the supply of silver just to make all these solar panels. If the whole world's going green and is not going to be burning coal anymore and whatever, and we're all going to use solar panels in the future, where's all the silver going to come from to make all the solar panels? I mean, if you look at all the new age technology, they need metals. Metals are the new oil, whereas you don't need oil and coal so much going forward. The replacement are certain types of metals.
But do you think that we are actually ready for that? Because one argument that I have here is, yes, the world wants to go green, but if we are going into a recession, those kind of green energy, they are quite expensive as well. So it's not that then at the end we are gonna see kind of like a rebound in the oil industry, which was going maybe through a decline, but it's kind of like the most common and probably the best source of energy when we are going into recession.
Well, the oil industry, the problems in the oil industry will be solved by cutting down on supply rather than dealing with. So the oil market will balance supply and demand by cutting supply. So if demand drops off, supply will drop off to go with it. What supply will drop off? All the American shale oil industry, because that's where the expensive oil is. So if a shale oil needs $50 a barrel to break even and oil's $40 or goes down to $35, more shale oil companies go bust. That shale oil is taken off the market, and the market will balance, come into supply and demand will come into balance. Also, in Asia, it's questionable whether you're going to see any fall off in oil demand. I mean, oil demand in China is the economy's back growing again. And we suspect that all these Asian economies that surround China, they will come, Korea's already come through the coronavirus much better, Japan, Thailand, Vietnam, all these economies are going to start growing at 4 or 5% again, way long before the Europe or America grows anywhere near 5%. So again, there's big structural shifts taking place where the Asian economies are going to start to massively outperform the Western economies. So the vulnerable energy is probably coal, as you saw yesterday. BHP Billiton want to dump them, trying to get rid of all their coal assets. So it's coal probably rather than oil that will get dumped. But we will move to more solar panels and more than wind farms. And it's been happening for 4 or 5 years, and it will just rise exponentially from here. And the greater the mass of solar panels, the more the unit costs will come down, and the technology is increasing all the time, and the prices will reflect that as well. So solar panels is the energy of the future. There's no question about that. And
okay.
It's not.
Okay, Ian, maybe to finish off, do you like maybe to give to share some ideas about gold companies or silver company that you have on your radar? They're also private investors can have a look into, as they are thinking about investing in precious metals.
Well, can do. I mean, we would favour silver miners over gold miners at the moment. We think that. I mean, there's been such a big move in the last month in silver. I mean, silver's up 50% in the last 3 weeks, and it's happened so quickly that a lot of the analysts who analyse these silver mining companies haven't had time to start upgrading all their earnings. But the upgrade in the earnings is going to be massive. I mean, most of these silver mines had all-in sustaining costs of about $12, $13 an ounce. And they were doing all right, selling silver at $19 an ounce. And then 3 weeks later, it's $27, $28 an ounce. It's gone up 50% in 3 weeks. Now, the effect on the profitability and cash flow on these companies is huge, on the assumption that the price holds. Obviously, if it goes up to $28, stays there for a couple of days and goes back down again, it won't affect the earnings of the companies. If it goes up and stays up, all of a sudden, you're going to see massive upgrades in all these earnings. And we don't think it's going to stop at 28. We think it's probably going to go up to 36, which means it will have almost doubled from its sort of $17, $18 it was a couple of months ago. So the silver miners, now you're not going to see even remotely any sort of percentage move like that in gold. So the gold miners, while they'll probably do okay, they don't have the potential upside that the silver miners do. And that's not necessarily predicated on silver going up to 36. That's just on silver just holding where it is. If it can maintain its level, the silver mines all have some re-rating to do. And the trouble is, it's happened so quickly. The analysts can't keep up with the earnings upgrades, and they want to. And to be fair, they want to see the price maintained. So it's got to go up and stay up. Now, if it's gone up, if it stays up, then you're going to get the earnings upgrades. Then you're going to start to see the shares perform.
Yeah. Do you have any companies, any silver mine that you would like to bring to our attention?
Well, I'll mention one. I don't really want to mention lots of them. But our favourite silver mine is Mag Silver, which we think is great.
Okay. Any gold mine that is worthwhile to look at?
To be honest, from starting here today, we think it'd be quite difficult for an average gold mine to keep up with an average silver mine. So if you've only got a finite amount of money, silver miners offer a much better bet, I would have thought, here.
Okay, Ian, thank you so much. That was really good, and we got a really good insight, I think, on on investment and also what is best now in terms of should I buy silver or should I buy gold?
No, silver is a much better buy here.
Okay, Ian, thank you so much, and I hope to have you back when we will see the price of silver going even higher, so we can see what is next.
But I think the silver mines will go up, even if the silver price doesn't go up from here, because they haven't fully reacted to the rise we've seen in the last 3 weeks.
Yeah, exactly. But, they always take time to catch up.
Oh, yeah, exactly. Well, as I say, the market has to wait to see that the price is going to be maintained at this level. If silver goes from 19 to 28, stays there for 5 days and goes, it doesn't affect their annual profits. But if it goes up to 29, 28 and stays there, that has an enormous impact on their profits. So we've seen phase one, the price has gone up. We now seem to see phase two, it has to maintain at these levels or go higher. And then you'll see some really serious action in some of these silver mines.
Okay. Ian, thank you so much.
All right. See ya. Bye.